Good afternoon, everyone. This is Chuck Self, Chief Investment Officer for iSectors. I'd like to thank you for joining us today to review the iSectors First Quarter 2017 Performance Update. I will be providing a brief first quarter performance overview of all the iSectors models and conclude with a research brief on markets. The post-MPT allocations underperformed their benchmarks in the first quarter. Both post-MPT allocations were negatively impacted by energy holdings. These strategies were helped by technology and financial stock allocations. As you know, the so-called Trump trade continued to take place through February. As presented in the chart on slide 2, sectors such as technology and financials continued to move positively in response to the November election results. Energy did not fare so well. By the end of the quarter, post-MPT growth had added to its energy and financial overweighting slightly. In post-MPT growth, over one-half of the allocation continues to be in energy and utility stocks. Post-MPT moderate is more conservative, with strong allocations to treasury bonds and financials. The iSectors post-MPT allocations continue to outpace other ETF strategies. We are pleased that growth is ranked first among all 40 global allocation ETF strategies for 10-year performance in the Morningstar ETF Managed Portfolio database. Investment advisors will be wise to consider post-MPT growth and moderate allocations as core components for clients' portfolios. The endowment and liquid alternative strategies outperformed their benchmarks in the quarter. As indicated by the black line representing Central Fund of Canada, a gold bullion trust, precious metals funds were strong performers in both allocations. The endowment allocation also benefited from its growth equity holdings. You will also see from the red line representing one of our hedged equity funds that short positions in these funds held back returns. Both allocations are broadly diversified and will continue to take advantage of the secularly bullish commodity market. Also should be noted that the liquid alternatives allocation has outperformed hedge funds over the past 5 years. Given the advantages of the allocation, including daily liquidity, complete transparency, availability to all clients, not just accredited ones, and a current yield of 2.6%, liquid alternatives should be considered for diversification in case equity returns ease. The global allocations turned in mixed results for the quarter. Domestic equities underperformed global equities, and they both fell behind the Standard & Poor's 500. Both equity allocations benefited from growth holdings, while small cap and high dividend funds detracted from performance. The global fixed income allocation was positively impacted by preferred stock and international corporate weightings in the quarter. The allocation was hurt by U.S. mortgage and Treasury inflation protection holdings. The iSectors domestic equity allocation has earned very attractive returns over the past 5 years compared to most large cap blend strategies. In fact, the domestic equity allocation is ranked 15th out of all 701 ETF strategies in the Morningstar database for 3-year performance. The combination of iSectors post-MPT growth and domestic or global equity has been a very powerful core equity combination historically. As we discussed in last quarter's webinar, iSectors is pleased to announce our 15th strategy, the domestic fixed income allocation. As interest rates begin to rise, advisors and their clients need a strategy that attempts to minimize realized losses, earn attractive yields, while providing complete liquidity. The domestic fixed income allocation was created to meet these goals. As you see on slide 5, the portfolio consists of 55% investment-grade corporate bonds and 45% high-yield corporate bonds spread over 2,800 plus issues. The allocation owned these bonds through defined maturity exchange-traded funds laddered from 1 to 5 years of maturity. These funds hold a diversified group of bonds all maturing in the same year. Monthly, interest earned in the funds is paid to shareholders. On December 31 of the maturity year, the ETF is extinguished and the undistributed principal and interest proceeds are released to investors. Since there is no trading in the funds and all the bonds mature before the ETF is extinguished, realized losses are minimized. With a current yield of 3%, you may want to make this allocation a core holding in clients' fixed income portfolios. The inflation protection and precious metals allocations surged during the quarter. Precious metals rose almost 12%. Over the past 12 months, the inflation protection allocation is up over 8%. As indicated in the chart on slide 6, precious metals, especially palladium and gold bullion, helped both allocations' results. Broad commodity funds negatively impacted the inflation protection allocation. We continue to believe that a 10% to 20% allocation of precious metals, inflation protection, or liquid alternatives will be worthwhile given our view that the next 5 years in the equity markets will not be as profitable as the last 5 years. The tactical global balanced allocation underperformed its 60% stocks, 40% bond benchmark in the first quarter. As represented by the red line shown in the chart on slide 7, broad commodity funds was the leading underperformer for the allocation in the quarter. International equities, as graphed in black, using the price movement of the Vanguard FTSE Developed Markets Fund, enhanced returns. Although the strategy still has 40% of its portfolio in cash equivalents, it continues to be invested in commodities and all equity classes. Finally, the chart on slide 8 indicates that capital preservation has earned almost 1.8% on an annualized basis over the past 5 years. The yield is attractive with a short duration while maintaining investment-grade quality on average. Capital preservation rose during the quarter due to mortgage bond and high-yield holdings. The iSectors global equity allocation has begun to outperform the domestic equity strategy. Is it too late to increase diversification by allocating some of clients' core equity holdings globally? We believe that global equity will continue to present better results over the next 5 years. As the left side chart on slide 9 indicates, the U.S. has been the leading market for earnings growth since the Great Recession. But the first quarter U.S. real GDP reading, expected to be in the 0.5% to 1.0% range, indicates that tightening monetary policy and capacity constraints in the U.S. will slow economic growth going forward. The rest of the world is benefiting from loose monetary policy and should continue to see earnings growth accelerate off the 2016 cyclical lows. Emerging markets were especially hard hit by the strong dollar and commodity weakness from 2011 to 2016. Even with the brief dollar rally after the election, emerging market earnings have rebounded well over the past year or so. As consumer demand from these countries become more robust, we expect continued strong earnings growth ahead for the emerging market sector. Finally, even with the recent outperformance, international market valuations are more attractive than that of the U.S. The chart on the right side of slide 9 indicates that the U.S., represented by the bar on the far left, has a relatively high P/E based on future earnings estimates compared to all other markets. Our global equity allocation, with a 30% allocation to non-U.S. developed and emerging market securities, should be considered for client portfolios. Please carefully inspect the disclosure page. I wish to conclude by thanking everyone for attending our webinar this afternoon. If there's anything we can do to assist you with your wealth management or 401k asset allocation needs, please let us know. We can be reached directly at 800-869-5184. Again, thank you and hope you all continue to have a profitable 2017.